Question number 4. H Limited agrees to buy over the business of B Limited. Okay, H Limited agrees to buy B Limited. Effective 1st April 2012. The summarized balance sheets of H Limited and B Limited as on 31st March 2012 are as follows. Okay, so this is the balance sheet. Okay, so what all we have? Liabilities and assets. And in liabilities, we have paid up share capital. And in case of H, it is equity shares of rupees 100 each. In case of B, it is equity shares of rupees 10 each. And we have reserves and surplus. Okay, and in assets, we have net fixed assets, net current assets, and deferred tax assets and total. Right? H Limited proposes to buy out B Limited, and the following information is provided to you as part of the scheme of buying. The weighted average post tax maintainable profits of H Limited and B Limited for the last 4 years are 300 crores and 10 crores respectively. So for H it is 300 crores and for B it is 10 crores. Next, both the companies envisage a capitalization rate of 8%. Okay. So post tax maintainable profits by capitalization rate will give us the business value, right? Okay. Next, H Limited has a contingent liability of 300 crores as on 31st March 2012. Okay. Next, H Limited to issue shares of rupees 100 each to shareholders of B Limited in terms of exchange ratio as arrived on a fair value basis. Okay. Please consider weights of 1 and 3 for the value of shares arrived on net asset basis and earnings capitalization method respectively for both H Limited and B Limited. You are required to arrive at the value of shares of both H Limited and B Limited under first net asset value method, earnings capitalization method, and exchange ratio of shares of H Limited to be issued to shareholders of B Limited on a fair value basis, taking into consideration the assumption mentioned in point 4 above. Okay. So net asset value method, earnings capitalization method, and exchange ratio of shares of H Limited to be issued to shareholders of B Limited. Let us start solving the problem. Question number 4. Net assets H Limited B. So what is the net assets? It is 1300 crores. Any liability? No, there is no liability here. But if you see, there's a contingent liability of 300. So 1300 crores minus 300 crores is the net assets. Now, if I want to find out per share value, then it will be net assets divided by number of equity shares. So, what is the number of equity shares? Paid up share capital is 350 crores and face value is 100. So, 350 crores by 100 is 3.5 crores, right? So, the per share value will be 1300 crores minus 300 crores divided by 3.5 crores. So, it is 1300 crores minus 300 crores divided by 3.5 crores, that is equal to 1300 minus 300 is 1000 crores by 3.5 crores, that is rupees 285.71. Now let us compute for B Limited. So what is the total asset? It is 31.5. Any liabilities? No liability. Is there any contingent liability? No. So the net assets will be 31.5 crores, right? So what is the number of equity shares here? If you see, the paid up capital is 6.5 crore divided by face value, that is 10, will give us 0.65 crore number of shares. Rupees 31.5 crores by 0.65 crores, that is equal to rupees 48.46. Next, earnings capitalization method, H limited and B limited. So what is earnings capitalization method? It is weighted average post-tax maintainable profits by capitalization rate. So in case of H, it is rupees 300 crores by 8%. In case of B, it is rupees 10 crores by 8%. Rupees 300 crores by 8%. Rupees 10 crores by 8%. So this is the value of H limited and this is the value of B limited. Now if I have to find out per share value, then I have to divide this by number of shares, that is 3.5 crores here, and here it is 0.65 crores. So the per share value of H limited will be 300 crores by 8% divided by 3.5 crores, rupees 1071.43. Next, 10 crores by 8% divided by 0.65 crores, rupees 192.31. So now in order to find the fair value, we will take value as per net assets method and value as per earnings capitalization method and assign weights to each of these values and then find the fair value. Okay, so in case of H limited, the value as per net assets method is rupees 285.71 and as per earnings capitalization method it is 1071.43. So now we will assign weights. So for net asset basis it is 1 and for earnings capitalization method it is 3 into 1 into 3, and we will divide this by 4. 1 plus 3 is 4, right? Solving this we get rupees 875. Similarly in case of B it will be as per net assets method it is rupees 48.46, right? And as per earnings capitalization method it is rupees 192.31, right? Now let us assign weights. Here it is 1, here it is 3, and total it is 4. 156.35. Okay. So these are the values. Now we need to find what is the exchange ratio. Exchange ratio. So who is issuing shares? H is it's issuing its shares to B limited, right? So exchange ratio would be rupees 156.35 by rupees 875, that is 0.1787. 0.1787. Also we will write a note stating that contingent liability in case of H limited is assumed to be materialized at its full amount. Therefore, H limited should issue 0.1787 shares for every share of B Limited. This is the solution to the problem.